Our market master today is Harsha Upadhyaya, Chief Investment Officer, Equity at Kotak Mutual Fund. Harsha, great to have you with us here. Thank you very much for your time. I'm not sure if you've spoken with your debt counterpart this morning, Harsha, and how they are feeling. I mean, if you have, and any feedback as a fund house.
Good morning, Prashant. Clearly, what has come out last night is a negative surprise for debt mutual funds. But even within debt mutual funds, there are two categories, I would say. Those who come in for parking their investments in the short term, and those who really look for indexation benefits. And those set of investors obviously will be disappointed because it's not going to be available post end of this financial year. For the rest of the debt investors, there is no change in terms of the taxation because they were even earlier looking at exiting in the short term. For them, there is no impact. But when you look at the overall industry, there is about 15% of total industry AUM, which probably would be based on the indexation benefits. And that category is unlikely to grow from here on. Rest of the categories, there is no impact. And probably the rest of the categories could get some of the flows that will probably move from this indexation category into other categories.
Right. Harsha, how are you generally feeling about the market right now? We've been in a bit of a range, and as we speak, the opening high has actually been sold into the Nifty at the low point of trade. It is dragged low by the banking stocks. We have some sell-off coming in from the IT pack as well, which is now off highs. And just looking at Reliance, that heavyweight too has moved to the low point of trade. So that's weighing down on the index. What are your general thoughts on the market right now, Harsha?
Mangala, we continue to believe that while valuation risk has reduced in the markets, there are macroeconomic challenges that one will have to keep looking at. So to that extent, we may still remain in a range. There are no real triggers for a great rally from these levels at this point of time. So only when you see some visibility in terms of improving earnings trajectory or some of the macroeconomic headwinds kind of subsiding, you will probably see a rally. But until then, we believe it's going to be a range-bound market.
So then, what are you buying in this range-bound period, Harsha? Morning, Surabhi here. I think for investors, it's getting a little difficult because patience has been tested all of 2022 and 23. So far, we are down. So I'm sure people are wondering really, how to look at things.
True, Surabhi, but these are the periods where you have to keep doing what you're supposed to do in terms of investment discipline. And generally, after periods of consolidation or after periods of a negative drawdown, you usually see great returns coming from equities. So one can't say when it's going to change, but definitely these are not the levels or the after a time correction of about 1.5 years in the same range. These are not the periods where you should lose your patience and start to do something else. I think clearly what you believe in terms of fundamentals, where you believe there is going to be some steadiness in earnings is where you need to keep picking your choices. Clearly, our focus has been domestic businesses where we believe both growth as well as in terms of demand trends should be clearly in favor of these companies. And that's the pocket that we are focusing on.
And what would those pockets be? Where are you seeing some value?
Banking, auto, cement, industrials. These are some of the pockets where we have been overweight for quite some time and continue to focus on these. Clearly, this is not a market where you will see a uniform rally across the sector. But definitely within these 4 or 5 sectors, definitely you will get good choices.
Okay, you'll get good choices. Would you reckon, Harsha, that in consumer names, right? Consumer discretionary names, there were lots of these fancy themes. Footwear suddenly became the hot sector, and many others as well. I'm just mentioning footwear because of campus and the block, etc., which has happened. Have valuations come to more reasonable, attractive levels, or you think there is still some ways to go? What's your sense?
In our opinion, it's still expensive, Prashant. Clearly, these were the pockets which performed much better than the rest of the market for a good 3-4 years until maybe last couple of quarters or so. Since then, we have seen a kind of slowdown in terms of demand, which still continues. And also we have seen inflation eating into profitability margins. So at this point of time, not only valuations are expensive, but I think at least in the immediate term, the earnings growth trajectory is also lower than what people were anticipating, and also worse than what the long-term trends have been for this segment. So to that extent, we don't see this pocket outperforming in the immediate term. But yes, many of these companies have very good strength in terms of brand, in terms of distribution network, in terms of how they've survived various cycles. So post this downturn, definitely there will be a few good picks that you can buy into. So this is something that we will have to keep monitoring for the next couple of quarters and see where that value emerges.
Harsha, thoughts on two areas of the market that have been beaten down quite badly. One is obviously IT services, and the other is this whole new age playground. And we've seen what's happened to the stock prices, right? Major value destruction from the listing highs. Are you looking at either?
We do have some positions in IT services segment where we believe valuations have corrected quite nicely over the last 15, 18 months. But yes, there are still some concerns on the business side, whether the momentum will remain the same as what the market is expecting, etc. And given the fact that interest rate hikes are still continuing and we don't see any reversal anytime soon, there is going to be definitely some impact on the global growth as we go ahead. And if that were to come by, there will be some slowdown in terms of the business momentum. So whether everything has been discounted or not is a question. But from peak valuation levels, most of these have corrected to reasonable valuation levels. So we do have some positions in IT services. But as far as some of the new age businesses are concerned, we are still not so comfortable in terms of the valuations. And we have largely been avoiding these names in our portfolios.
Harsha, one of the big trends that emerged all of last couple of years was the K-shaped growth that everyone's talking about, strong demand at the higher end of the luxury segment and, decaying demand at the lower end of the consumer spectrum. How do you play that, if at all you do, and what stocks would you back in the consumer space then, if at all?
We do have positions in auto, for example, which I would consider as higher end of consumption demand categories, where we believe that as inflation moderates and since some of the new products have evinced good interest from the customers, there is outperformance to be achieved in that particular segment. But as far as some of the other themes in the consumption which are related to rural segment, for example, I think the slowdown still continues and we may have some more time before we start looking at some of these names aggressively. As I mentioned earlier, I think we would need a little bit more of comfort in terms of valuations to get into some of these names going on.
You said it'll be difficult to make money this year. I mean, would you have any sort of, number to that? This year, would we underperform debt? How would we do going forward? I mean, the Nifty year-end target, if at all?
We don't work with any targets, but clearly I think with the correction that we have seen over the past couple of months, valuations have become more reasonable. So to that extent, I think from here on, the market returns could track earnings growth, which is likely to be decent. It may not be as strong as what the market has been expecting, which is around the mid-teens, but it still should be decent. So our belief is once the short-term volatility subsides, you should see markets moving more in line with earnings growth over the next 1 year or 2 years.
All right, Harsha, we'll leave it there. Thank you very much for your time. Appreciate you joining in with that perspective. Thanks indeed. The market